investment advisors, not registered with the SEC nor FINRA. If you do have questions about your own personal finance trade advice. And finally, myself and or the team at Yellow Tunnel or Tradespoon may have a financial interest in the securities presented in the trade ideas. So do please keep that in mind as you evaluate trades that we discuss for your own personal financial investment and trading portfolio suitability. Yesterday was a boring day, right? No, we had the whipsaws. One of the things I was talking about yesterday is that the market was underpricing that same day straddle, but it shocked me the way that we were moving. Really in that last half hour, I think was the biggest surprise to me. So all in all, we've got a very much a fighting market, the very uncertain market, not sure what to do market. We're waiting on news blurbs, what's going to happen with tariffs, what's going to happen with fundamentals that impact how people then respond. We had some good signs yesterday as we consolidated near the lows and then started to ramp back up. Pushed back through 500 up to 503 and change in Qs, for example, but then closed back down towards 495. So an $8 swing in the last half hour of the trading day was pretty vicious, obviously. Right now, just got to kind of buckle up and be ready for the market to continue to potentially keep chopping. At some point, this volatility will start to slow down and people will get a little more confidence in investing. It's very difficult, generally speaking, when you've got a volatile market to find investment flow because liquidity isn't great. And these swings tend to basically work best for the day trader until the fundamentals are there. And then we can digest. And then the liquidity starts to come back in and values start to find their equilibrium to then decide what goes up and what goes down. Right now, it's very random walk, skittish behavior. We know long-term where we're going, generally speaking. The market over the long haul, complete destruction of the U.S. economic system. What do I think is going to happen in 5 years? Probably higher. What do I think is going to happen in 5 days? I don't know. What do I think is going to happen in 5 minutes? That actually can be a little bit more tradable. Because right now we've got just taking those charts where we look at daily moves and start looking at 10-minute charts, 15-minute charts, and apply the same sort of technical analysis to the shorter time horizon because we're getting the moves that we used to get over days or weeks in a matter of that means I can't necessarily make a trade like a credit put spread expecting it to pay off in 10 minutes because expiration is not every 10 minutes, it's every day or every week, every day in the in like SPY, QQQ, and IWM, every week in most normal ETFs, and some of them every month. So what do we do? Well, I think that right now, I think more cash makes more sense. Understand the portfolio drawdown risk. If not in line with the whipsaw, why trade the whipsaw? Wait for the whipsaw to end. It shouldn't last forever. It shouldn't last more than a few more days, most likely. I think as the tariff stuff kind of gets resolved or clarified, then at least it's known. And then we can see the market react in a more rational fashion. But when it's unknown and there are shifts and changes in policy, potentially every hour, every day, that makes it harder to trade the fundamental inputs. And then the technicals can kind of drive it, but also they're being driven by fundamentals, and there's a lot of noise in this market. One of the things we always talk about is the signal versus the noise. Right now, it's a very noisy, especially on those daily and so that's like a short-term thing where there's a lot of signals on the very short term, a lot of noise on the daily charts, and a lot of signals for the long-term charts. Because long-term, if I took like a monthly chart, it would actually start to get a little bit clearer that, the chop is actually just more of a consolidation when you look at it in a really long-term chart. All right. Managing the position entry and exit can also be a little bit difficult right now because, frankly, prices are moving. Options move 15, 20, 30% in a few minutes just because of the price action. So stability of the markets is going to make a lot of these other general trading theories work a lot better for most traders. The more and more right now, the high frequency traders are probably should be loving this because they're getting a lot of volume and wider spreads and a lot of movement. Yeah, let me just think through this. Some of this stuff. I mean, we don't have a trend right now. The trend is chop. The trend is whipsaw. So 2 to 3 days of stable type movement can get us back into a period of normalcy. We didn't see it yesterday. We didn't see it the day before. Whipsaw is the trend. Just be prepared for potentially vicious, violent moves intraday. And one of the things that I think is important with that is the psychology of these whipsaws. Yesterday when Qs were trading 503 and looking like the bottom was in and everything was peachy, I was sitting there thinking to myself, gosh, back down at 490, 490, went back to 495, but I didn't want to buy anymore. So, you sit there and you got to go back and forth in your own brain and balance out I wish I did because of where prices are now, but if prices went right back there, would I want to buy? That helps dictate for me a reminder of, well, when we were down there, the risk was high to the downside or the upside. Took a couple small positions for the upside. That worked out. But then by the time we go back to 495, anything that I hadn't closed on the rally left me with a break even or small loss or small gain. So the unrealized profit is the stuff that looked really good. And I kept some stuff on near the highs that I wish I'd taken off now near the highs. I took some stuff off near the highs. That's a good thing. But to sit there and think, gosh, I wish I was longer at the highs and less long at the lows. Well, that's the nature of options, right? Buying low delta, high gamma calls for the big whipsaw can make me lightly long at the lows and very long at the highs. The question becomes, how do I manage the exit side of things? Am I piecing off? Am I hedging? Am I reducing my risk into those highs, or am I trying to maintain that throughout? And I think half can be a very good strategy, because if you take off half, then if you pull back, at least you've captured maybe your initial investment or more, depending upon the options chosen, in order to then potentially reallocate to something new. All right. I don't want to get overly complicated personally with long and short the market at the same time with certain bias. The only reason I'd have long and shorts right now is if I have an investment portfolio and I'm trying to manage risk with some short side ETFs. So saying I've been long a lot of stuff, I've got to draw down, I need to manage my risk. I don't want to sell these individually very good companies that are oversold relative to the market. I'd rather sell a little bit in the market, hope I lose on that hedge, buy a put on the market, whatever, and be prepared for then some neutralization of the loss if we go down that direction. But that's a risk management side of things as opposed to a leverage side of things. If I see a short, I want to be short. If I see a long, I want to be long. It goes back to the KISS, keep it simple, stupid. So keep it simple. Having flexibility is best suited when it's simple. All right. Allowing more time, I don't think makes any sense unless you're going for an investment thesis. And then, put all the time you want, but just know that you got to get that appreciation starting to work. And the VIX being higher and the long-term implied volatility being higher means that some of those call options are expensive, and you need to see this reminds me of back when COVID was first coming in to a certain extent. We're not nearly the same dip, but when COVID dip happened, I was looking at some of those midterm and based upon where implied volatility had gone at that time, it was a lot higher, of course. We really needed a retracement of about half of the COVID break just to get back to money call options. So if I'm allowing for more time, I'm doing so with spreads right now. Investment thesis, yes. But if I'm wanting to buy into Palantir for the long-term investment portfolio, I have to still do it with a call spread in order to reduce the cost, whatever it is, an 85, 110 call spread. And if we start to rally, I just have to reposition. So it's not about capping my profit at 110. It's about understanding that I need to not have it has built up to the implied volatility to a certain extent. So going into a call spread now and replacing it with an outright call or a credit put spread or something later when market conditions change is the rational way for me to do that. Debit spread for the longer haul potentially makes sense for those looking for this as a value buying opportunity. All right. I think yesterday we hit a pretty good volume in VIX level. We'll look at some of those numbers today. Earnings dates are still, to me, a little bit less relevant. So they have to be input it into my understanding that this stock may not move with the market for that day. But then once the market starts moving and earnings have already come out, it's moving too. So we're getting so much movement without the earnings that I'm not as big on trying to pin a earnings play for this week. We still got to deal with some tariff conversation here. We still got non-farm payrolls this week. I'll look at the earnings names, but I tell you right now, I think the better play is to wait for earnings to happen and then trade reactively afterwards, because a lot of times that implied volatility gets sucked out in that first 24 hours after the earnings comes out. And it may actually get hit a little too much if the market is somewhat stable for a couple of hour period, allowing for actually a leveraged trade opportunity with some market exposure. But generally speaking, I think when the market's doing what it's doing, staying liquid with like Qs and SPY and IWM type trades is oftentimes most rational. All right. Or looking into some of the foreign ETFs like China, whatever, Europe, and saying that they're not experiencing nearly the same volatility as the United States market right now. And so the liquidity there is a little bit more easily found. All right. So we're looking for that signs of bottoming process at 2:30. It looked clear again. 3:30 Eastern. It looked pretty clear. By 4 o'clock Eastern, it seemed questionable again. So we're still going through it. We're still in the process. It may take another couple of days, but a couple of days of light trading for some exposure, but knowing that I don't want to be all in when the market's getting a lot more volatile is the key. All right, so the 10-year yield bounced off of 410, went back up to 420. I'd like to see, honestly, the 10-year yield around 430, 440 range to have some better stability. But right now we're still dealing with the concerns over the economy and the tariff impact and everything that's associated with that. So we're getting lower interest rates over economic recession concerns at the same time as having to worry about potential for inflation. So this is a very concerning point for the Fed. If we've got inflation and a recession, we got a problem. They can't lower rates because of inflation. They can't raise rates because of a recession. How can the Fed fix it? So ideally, these economic policies over the medium and long term create stability and growth for the market. And that's what Trump has said that he believes they will do. Others say that it will just create negatives for the economy. The only way we'll know for sure is fast forward a year and see how the earnings have gone for the United States. And we use the stock market as a proxy for economic growth, but we all know that the stock market can go up even if people are struggling economically because of price increases and other things like that. So if the goal is to show a strong economy through price growth in the stock market, that may be achieved through the tariffs. If it is to be sure that every individual is feeling stable on an economic basis, that may or may not be the case, even if the stock market is going to new highs. So I don't know. I'm not sure how exactly it's going to play out. I don't think anybody is. But all we can do is let the data tell us as time passes. All right. When I go to Bitcoin, that was a whipsaw as well, especially the last few days, right? So Friday we had the liquidation and the bounce back. Monday we had the crypto reserve announcement and the fallback. Tuesday, a bit of a drop, but nothing crazy, and then a rally. And then today we're rallying again back up towards 90,000. 91 was the high, currently trading 89.5. Bitcoin is actually looking almost the most stable out there in terms of some of the risk on behavior. It looks like it wants to go back to 96 and sit. But maybe Mara, Riot, HUT, BTDR, or going into like the Coinbase or the Robinhood type names can be interesting, and we'll take a look at those here in a moment. MMFI showing our percentage of stocks below the 50-day moving average. We got real low yesterday. So we got down really close to the January 13th low, 24, I call it 25%. Yesterday's low was 26%. So that could be another good sign of a potential bottom. So what was January 13th versus January 14th on the market? Well, January 13th was this low, and January 14th was the resumption of the uptrend. So if we see a little bit of bounce back today, again, I'm looking like for 583-ish in SPY. Ideally, honestly, for the bull, we go up to 586, and I might say to myself, gosh, I missed out on the first 10 bucks of the rally. But then that gives me the confidence that there's more to come, potentially. Right now, we are unchanged. A sigh of relief from the market. We haven't moved much yet. If that stability can lead to a drop in the VIX, which right now is up and near the highs again, then maybe that can actually start to get some investment back into the market and also create that positive cash flow, money flow rally. Right now, with the VIX at 24, people are nervous. Under 22, when we were at the highs yesterday, people were starting to get a little bit more confidence, self-included. But then we dipped back down and pushed back towards 24% by the close, and 23.5% by the close, and we're back in concerned mode for the broad market. But I do actually like seeing for the trading opportunity, the NASDAQ unchanged, Russell unchanged, S&P is unchanged, Dow Jones unchanged. Now the question is if the VIX can start to fall or if the VIX is going to stay elevated through this unchanged market. SQDX also yesterday was down again. So into that rally, it looked like maybe people started pitching some puts, maybe still buying put spreads. I've heard, pundits on CNBC and stuff talking about how to hedge their portfolio, and they're all talking, puts are too expensive, but you can buy a put spread. You don't have to buy a 490 put in QQQ. You can buy a 490, 450 put spread, reduce the cost from $15 to $9. And yeah, you've got capped risk reduction there, because if we go below 450, you're not making much more money. But if your thesis and your goal is to buy into that dip, and if we get a 10% dip, am I buying? I don't know. But if you think you are, if that's the investment thesis, then that's the hedge to the investment portfolio. 450, by the way, is down at the 6 month level, the 6 month ago level. So September 6th was 450. If I go out a year, we had 450 on 425 on August 5th, 450 on September 6th. So that is a big key level. If we were to get down there, obviously if it happens fast, none of these support levels matter much. But if we start grinding down, 450 could be an interesting support level. Support levels from the chop, right? We have here near these lows for 77 to 484 range. We haven't tested it yet. And Qs are generally still weak, but not as weak as S&Ps yesterday. Right, so Qs closed above Monday's low, SPY closed below Monday's low, IWM closed IA, more industrials, closed below Monday's low and looks the weakest of those four. So I don't normally look at DIA, but I think it's important to note that the Dow Jones Industrial Average looked particularly weak yesterday, but is still above the 200-day moving average, while small caps are below. And tech is right on it, and S&Ps had tested it yesterday but didn't quite get to it and are a little bit above. So weakest is small cap, then comes tech, then comes the broad market, then comes the industrials. Is that the right order for our long-term trends? To be determined. And we're still moving in chunks. So, we see tech right now, you can just watch the prices changing here. We got 4-cent wide markets in the underlying, and we're moving a nickel a dime at a time. So we're still moving in chunks, but they're smaller chunks than yesterday. For what I was talking about with the whipsaw, we had the fall off in the morning, generated some sort of support level, started to recover out of it here at about noon, and then rallied consistently for 3.5 hours. And then in a half an hour, dropped from 503.63 to a low of 494 before settling at 495. So we dropped $9 in a half hour. What we saw here, but this happened over a little bit longer time period. We dropped from 505 down to 494 and then bounced. Very similar kind of action. Concerning action. Selling near the close is not necessarily indicative of a bull market. Obviously, we're not in a bull market, but it's not indicative of investor confidence. But let's just let all these announcements come through, And once they're done and the market can digest, I think people will be looking for investment thesis. All right. They just don't want to do investment thesis in the fast market. All right. So we're dealing with fast market. Again, with QQQ, I look at SMH as my key normal leading indicator. And this is, I think, a big indication of why tech is weak. Semiconductors have been so very, very weak. They look more like small caps in terms of their weakness right now, well below all the key moving averages. And you can see all those moving averages, the mid and long term, all converging here. Generally when you got a bull market, longer term moving average, and then the 100-day moving average is above it, the 50 days above that, the 20 days above that, the 10 days above that, everything looks pretty peachy. Short-term momentum is stronger than long-term. When you've got a potentially turning market, you start seeing the short-term moving averages cross, and then the medium-term moving averages start to cross, and eventually, if we're in a bear market trading below the 200-day moving average for a long time period, they all cross. And with SMH, all of these moving averages, except for the very short term, have all converged. And now we're seeing the 50-day moving average go below the 200-day moving average. That's concerning. The 100-day moving average going potentially below the 200-day moving average. That's very concerning. But we are oversold, and that can quickly switch back to just chopping behavior. And when I see all of these clustered like this, it's really an indication that there's no trend at all in semiconductors for at least 6 months. And from 220 to 265, we haven't got anywhere. We're at the lows of the range. Maybe we bounce back, maybe we don't. The financials had a very weak day yesterday. Concerns over the economy, mixed concern for the financials. Is this an investing opportunity? Possibly. Is this a trading opportunity? Possibly. I do think that this is a sector that has generally greater stability. So I'm looking at some of the big cap financials for a short-term put credit spread, but probably not this week. Because we're still dealing with the whipsaw market, I don't want to do a put credit spread today. I got non-farm payrolls on Friday, so I don't really want to do one for Friday. I want to wait, and I want to look at it for Monday or Friday afternoon. Maybe I put on a put credit spread midday Friday once things have stabilized, once more of this tariff stuff is known, and once non-farm payrolls are known. Then I can start looking at a put credit spread based on the thesis that if JP Morgan is around here or maybe a little higher, should be holding above, say, the 245 level. Or Wells Fargo, if it's around here, maybe higher, should be staying above the 72.5 level. And if it starts going a lot higher, then I got to look for something new. I promised I'd look at some of the Bitcoin-related names just to bring them up here. MSTR, mega rally on Monday, completely washed it out. Looked potentially weak on Tuesday, recovered nicely, finished at 280. It's a bit of a whip. This is another whipsaw, but it is to note here that it is holding above the 200-day moving average, so starting to show some signs of where that support level is. Unfortunately, the resistance is probably around 3.25 for now. So unless Bitcoin starts pushing to 100,000, I'm not sure I see the breakout in MSTR. But maybe there's an opportunity in something like Riot. It did have weak earnings, but it is trading near the lows of the range. So looking for that to potentially catch up. Or Marathon, generally slightly positive now above the 10-day moving average. There might be some resistance at the 20, but the next real resistance is around 19.5. And in the option space, April 16 call on a move to 19.5 goes to $3.50. So do I see the opportunity here? Absolutely. Is the implied volatility low enough to trade something here? Absolutely. It's not that elevated. It went from 86 to 100. When I look at like NVIDIA, that's at 62 relative to a normal behavior around 38. So, it is a premium to its normal trading range, but not a massive premium to its normal trading range in terms of the implied volatility. So that could generate opportunity for the leveraged potential upside if the Bitcoin world is going to actually get bullish. And you can see Bitcoin implied volatility is about 10% higher than the norm. And, maybe it can get to 55. Maybe it can get to 58.5. If I go out to April, the move to 55 is priced in, right? So that's the difference between IBIT and MARA. MARA, that move on the recovery isn't priced in. IBIT, if we go to 55, these 52 money. The 51 calls break even. So I see more leverage in Mara. That's one of the early on maybe trades that I'm going to look at closer today, as long as the market seems to stay stable for a few hours. And right now we're getting a little bounce back. I will note back once again, just taking a look at the straddles, because that's our indication of the daily range expected by the market. We're saying about $7. So we're looking for a $7 move today. Keep that in mind when you're thinking about your trade pieces. That's saying that even though we didn't move overnight, we still have 1.5% in us today. Yeah, so Fred, that would be a good way for it. You're right. I think in IBIT, a covered call. And yeah, if Bitcoin goes to, $200,000, well, was I going to ride it all the way up? No, I would have been taking my profit anyway. So a covered call, effectively a short put strategy, that can make a lot of sense. And it could be a put credit spread as well at IBIT. It's just got to pick the right levels, right? So I will pull that back up before I go back to the Qs here. 46 was the low. Can't really get enough premium for this week on those type of strikes. Next week, the 46.45 put credit spread is about 15 cents. It's not a ton of money. If we get a little dip in Bitcoin, that could be decent appreciation. But at a 70 implied volatility, realized volatility has been 40 to 50. This is priced pretty high. So that premium is too high, in my opinion. Should it be trading closer to a dime, 8 cents, something like that? Probably. But it's at 15, and that could be an opportunity to generate about a 15 to 20% return on a lower risk, even though it's technically higher dollars risk versus reward. I think that the leverage that you're getting from selling that at like 15 cents can be a way to just build a little bit of cushion in the account in a lower risk way than trying to trade the whipsaw. So that is a spot where maybe sell and hold makes sense. Now, if we start dipping today towards 48, or strike like 45, 44, but for now, that doesn't look too bad to me. And then I just got to hold my breath for a week and a half. So back to the range on the Qs. We're still pricing in some probability of crazy movement. These March 505s are again 55 cents. That tells me that it's finishing in the money. They're willing to pay 55 cents, and it's $9 away. That's a pretty juicy call, because we are wondering if there's going to be something today that causes that rip right back up. Now, 505 might be a little high. I actually have just one of these. I'll probably pitch it as after we jump off. And if I want to buy something for a short-term move, go out to March 7th. The 505s are expensive. God, 515s are too expensive. Never mind. I'll probably just pitch this and to walk away from the short-term trading stuff. It was my way of staying engaged in the market, but it's, in my opinion, probably a negative expected value trade. Better suited is, honestly, as long as we show some stability during the day. Yesterday's lowest, if I'm looking for a short-term one-day trade, it's, a little risk, but a 488, 487 put credit spread for 20 cents. So then all I'm saying is that we have less than 20% chance of making a new low. Is that right? I think that there's less than 20% chance we make a new low. I might be wrong. So if I have an 80% chance of success for 20 cents of profit and potentially 80 cents of loss, it's a break even. If I think that there's only about a 5% chance that we're going to make a new low, then I need to look for some of these put credit spreads, something down here below 488. If I think that there is a greater than 20% chance of a new low, then I'm looking the opposite way. Maybe buying an outright 486 put as much as it's expensive, or a 486, 480 put spread. Because if we get below 488, I'm a little worried that the falling knife resumes. But that's why I do it as a put credit spread. They're very similar options. They're priced to just basically trade almost like a binary situation. And I'll say, like, on that note, these things can get real cheap real fast in the afternoon. I was very fortunate for the rally in QQQ yesterday because I had a short put spread on and I covered it. I bought the 500 499 put credit spread for 9 cents. And then, half an hour later, it's worth $1. So you get the movement, you just got to have a little bit of luck on your side on it. And it could take some time for this to decay down, but I think if within the first 2 hours of the trading day, we haven't moved much, this sort of stuff can start to decay. But it has pattern day trader risk to it. If you end up selling it and then buying it back, that's 2 trades. And you're only allowed 3 same day trades in a week if you're not able to do pat balance under $25,000. Yeah, SLB. So I think yesterday I said I wouldn't be adding here, and I should have said, yeah, keep adding. But no, so now what I was looking at that for this morning, I think that it's probably time to trim. Not that this move is over, but trimming can make some sense here. I think that we should be going up another 50 cents. But from what we've seen already, cover with profits in place, trimming a little bit makes some sense, booking some profits, because Lord knows if something comes out with tariffs or something bad comes out for silver and gold in non-farm payrolls on Friday, it could completely negate that. So either trimming or looking, like I mentioned before, at GLD put spreads. And GLD, by the way, is unchanged here. So silver is doing the catch up relative to gold. The long silver short gold spread working for today. Will it work tomorrow, or will it work in 3 hours? I don't know, but it is working for now at least. Speaking of silver, China. China looks really good here. Really strong bounce back. I am back into looking at a couple of stocks in the China space. BABA looking like a bull flag, up above yesterday's high. Looks like a potentially timely entry here for a move back to 145. Baidu is back on my radar again. So we had the dip below the 50-day moving average and then the recovery. Because I was looking at this for a put credit spread, it's not for this week. The 87.85 put credit spread for 30 cents is okay. But there's still a little bit more risk there than I think, maybe for 30 cents. I may take that back. I might do something here for 30 cents in the 87.85 put credit spread. I'll open here. Yeah, we were trading below it yesterday. That's my little bit of concern. I was thinking 5 cents. 30 cents for 2.5 days might not be bad as long as the market's not whipsawing back to the downside. JD has earnings. So I want JD to break out without earnings, but it's not going to happen. We got earnings tomorrow morning. So earnings tomorrow morning, traditionally in JD, we're looking at about a 7% move. If it's a bullish earnings, that's going to be a breakout to the upside, push us to 40 and 45.5 range right here, back towards the highs. If we do 7% to the downside, we're back to 40, just no low end of the range. So I'd love to see bullish earnings and a potential for breakout type trade here, but implied volatility is higher because of the fact that it's got earnings. So this is actually one I think that could be a trade from the earnings perspective, looking at 45 and 40 as targets. All right, because it is still liquid, because it is not moving with the market, because it is based in China, not in the United States. This is one of those few names that might actually generate a decent earnings setup because it's completely uncorrelated to the tariff stuff so far as we've seen. All right. So JD is the one earnings that I'm tempted by today. And since I mentioned earnings, why don't I run through them just so you guys have them on your radar because they may be indicators of what happens tomorrow in the market. Marvell, I think the company should have positive earnings. I generally lean bullish on it. Who knows for sure? 10% mover. Last time it was a 22% mover. So, I mean, if we do a 10% bullish move, it's $95, right? If we have a 10% bearish move, it's $78. So it's risky. 78 lines up actually right here at the breakout level from 4 months ago, 5 months ago. Do I think 95 is a stopping point on it? Honestly, that's the problem. I don't, We're pricing in, though, only a little bit more than the average expectation. when we've had these big moves in the past, in the last 2 years, last 5 years, I guess, the 3 times we had bigger than 15% moves, the next one was a small down move. The next one was a small down move. Will the pattern repeat? I don't know. We had a big down move, and then the next one was a smaller up move. So, in theory, I should probably be leaning on the bear side of this based upon historical behavior. But after the pullback we've seen, there's so much news coming out from tariffs that could drive the market anyway. You look at like yesterday, just to give a little bit of a comparison. Target started at 117.5, ripped all the way down to 112, and recovered back to 170 because the market whipsaw, even with the earnings. Best Buy started at 79 and closed out at 75. So we got a lot more movement on some of those bearish earnings names yesterday. And Okta started off bullish and then exploded to the upside and never pulled back. So, people are just going with what's going and ignoring price almost, it seems like. MDB, the momentum indicator, I guess, right? Stuff that's going up it keeps going up. Stuff that's going down keeps going down. That indicator apparently has not been working very well recently, though, because we're chopping so much. That it doesn't work for the broad market. It's been working for some names. MDB has earnings tomorrow as well. They are based out of New York, but they're developer databases. Basically, 14% mover. 14% of $250 is $35. 215 is off the charts. 286 on the upside is right near the highs of just a couple weeks ago. 300 would seem like a natural target point if we got bullish. 290 has the biggest open interest. The liquidity is garbage, and the stock's probably going to move too much. But it could be a good indicator of where the market's going. If MDB is bullish, and Marvel is bullish, then maybe we start talking about some of the underlying tech names being bullish still. Zscaler has earnings this afternoon. They are in the cyber functionalities, cloud security. Normally move about 5%. I've seen some bigger. The biggest thing that I wanted to note on this is CRWD's earnings were a bit of a disaster. So in that cybersecurity space, CRWD went down to 336. 350 looked like a spot that it could find some stability. We got just below that right now. But if that's any indication of bearish, and then the previous 5 were bullish, bearish, and then the previous 5. Yeah, so no correlation to ZS. But if it's any indication of the kind of move we could be getting, maybe we're looking at something more like 12% here. 12% is $20. So $20 down feels pretty nasty down at 170. I don't see any real support there. $20 up is 210, pretty close to the highs. Again, I think it's just I would rather trade this after the fact and focus on the bigger the tariff stuff, since it's grocery stores. %. So $1.80. I mean, that puts us at 65, 4.5, or down to 61. That's not a great optional bull trade here for like a double fly or anything. 64 big open interest could be a target, but because of the small move, it just doesn't seem great. Macy's is a $13 stock, so I think you have to pick a direction. Most people would probably say down. Normally moves about 5%. Again, we're only talking about like a 65-cent move down or a recovery to 14 on the upside. So, I'd almost rather just say, in this case, buy some stock. If you're bullish, sell some stock. If you're bearish. The March 7, 13.5 calls are 55 cents. So we'd have to get, that would be basically a break even on a normal size bullish move. And then Burlington, the last one, just to bring it up, is another retailer in the dumps. Earnings normally about 7.5% on average, but it's been pretty good dispersions of moves. 7.5% is about 18 bucks. Puts us back towards 250 on the upside. That's a decent looking target spot. 250. So maybe 220 and 250 for a double fly here could work, but with the market liquidity gone, it's probably a pass and just look and see what happens. So again, JD looks like a potentially tradable earnings. And if it's bullish and FXI is bullish, then this could set up a long-term holding in terms of the trade. If it starts getting into a bull trend and FXI is maintaining this bullishness relative to the broad market, China looks good. I think JD is a great avenue for potential trading opportunities for the next month or two on the bull side. But I need to see. So maybe the psychological hedge is actually to take the bearish put fly only and say, if we have a bearish scenario in JD, I'll make a little bit of money, but then I won't have a trading opportunity for a while. If we have the bullish scenario, I won't make any money, but now I might have a trading opportunity for a while. All right. Let's just double check. Yeah, I got to be honest. This might be the best trade I see today. You know, stable above 12 and a quarter right now. Look expensive. If I want to cheapen it even more, I mean, I'm buying 96 vol and selling like 106 vol by selling the 22s. It's a wide call spread. I don't think the 106 is even too high. You got the MACD crossing here. 22 seems like a pretty big reach. You'd have to get through a lot of resistance levels. That may be the first like sort of holding trade. That or like BABA as a multi-day trade starting to show signs. By the way, and we talked about it yesterday, how AT&T never goes down. Now AT&T went down. You know, T-Mobile never goes down. Now T-Mobile started coming down. So some of that unwind from those names that have been performing well during the market whipsaw, this is the risk that I was worried about for, you know, the insurance names. The insurance names didn't have the whipsaw down, but like, you know, it's down a little bit, but not terrible. Allstate hanging near the highs, down a little bit, but not terrible. But IAK is not getting the investment flow, and IAK had quite a bit of a pullback yesterday. So those names that had been getting bought as safe havens started getting sold. Again, that can be signs of the bottoming process. We're selling the baby out throwing the baby out with the bathwater, and then reallocating to some of the worst, or just taking to watch the Jets. As I think about this, they got hit really hard, and I don't disagree that travel can get hit when you got trade war stuff going on. But I want to see how this starts to recover over the next week, and then reevaluate some potential trade opportunities in United or Delta or American. Love finally broke the 200-day moving average very lightly, but it's been holding up okay against this low, bumping against it. If it breaks a little more, it might go into liquidation mode, but for now, it's been bumping up and holding. So no aggressive power trader names today. You know, too much whipsaw, right? So getting a little bit of a difficulty in finding the AI-based names. So it's more about trying to find signals within the noise from standard technical analysis and looking for low volatility sectors. XLU, generally a lower volatility, but looking weak here as people pitch some of that. It seems like they're looking for the opportunities in some of the other names. Gilead's going to break out. AbbVie is going to probably break out again. AstraZeneca still going. So I'm concerned about them when I see stuff like what I saw in AT&T yesterday. How much value do we see in those names if people are looking back at tech or semiconductors or AI? Do they have to sell these things and go back into the aggressive portfolio? And does that cause a pullback? Are these just going up because people have to be in the market, not because they are actually the best trade? They're just a safer trade. SMCI is one of the better performing semiconductors for the short term. Could be an interesting one. Oh, yeah, NVIDIA. I didn't really talk through NVIDIA in terms of their potential turnaround here. So 113 down to 110 is that risk zone. So it depends upon how you want to manage the trade. So what I generally do when I'm looking at a put credit spread is I take the support level as my short strike and my price that I want to stop out at my long strike. So that could be very well achieved through a 113, 110 put credit spread. If we go to 113 and hold, I'm between 113 and 110. And below 110, we're into liquidation mode. Implied more than this put in that sort of environment, usually in terms of implied volatility. So the delta's not working, but the vol is going in my favor. If I collect 75 cents now at 110, I'm probably getting out for about $1.80. So I'm risking about $1.10 to make 75 cents, $1.05 to make 75 cents. It's a balanced R&R, and the thing I need to not have happen is a collapse. Do I want to take the risk on two things, tariffs and non-farm payrolls? That's the ultimate deciding factor for trading today, tomorrow. Well, today and tomorrow, right? For trading today and tomorrow, I'm potentially putting myself at risk of two inputs, tariffs and non-farm payrolls. If I trade today to close tomorrow, I'm only trading for tariffs. If I trade it, if I hold it through the end of the week, I'm also including non-farm payrolls in my trade. If I don't want to trade those, if I only want to trade one or the other, you go to QQQ daily options, payrolls. If I want to trade non-farm payrolls and not tariffs, then I got to wait. Tariff announcements could come any minute, any day. And maybe it's not until Monday for the next announcement. Maybe it's not till Tuesday. But if I don't want to trade tariffs, I don't trade this market. If I don't want to trade the news potential from a tariff announcement, I can't trade this market at all, except for on a very, very short term whipsaw. Hear the news, see the technicals, take the trade out within an hour, 2 hours, 3 hours. A counter news blurb usually within a couple of hours. But we do sometimes see it same day right now. You know, we're getting count full force. Maybe we'll back them off on Wednesday. Maybe we won't back them off on Wednesday. Let's see what happens on Wednesday. If we back them off today, the market can rip up. That would be the normal expected at near lows or at lows or at unchanged. I don't know where we go if no news happens on tariffs today. The only thing I can think is that if there is any tariff news today, it's upside. So that gives me that potential for an upside play on a short term of like a 500 call for today, but that's expensive, $2. If we just go back to yesterday's highs around 503.5, sure, I make 75%, but if no news comes, I lose 100%. So is it a 50-50 chance of news? I don't know. Is a $6 move now instead of $7 more reasonable? Yeah. If there's news, we can move $10. If there's no news, we might not move. So that's why it's $6. It's basically trading the coin flip of news versus not news, right? So yeah, I mean, I think that with any of these things, it's all about right now deciding what fundamental input that I have no edge on. Maybe if I can predict with reasonability the reaction to the news once I know it's out. If the news is my price target, if I don't have a price range that I'm expecting on that news, then I don't have an edge. If I just think bullish, but I don't know if we're going to 500, 505, or 515, then I don't have an edge. If I think it's at least 505, I have a minor edge. If I think it's at least 510, I have a major edge. You have to evaluate for yourself. I don't think the market's going to go to 510. The market doesn't think that either, though. I mean, 11 cents for the 510 calls. Is that a tradable view that we're not going to go to 510 today? Not really. I'm not selling anything for a dime in this market because we might go to 510. We might go to 515. I'm not risking $500 to make 10. The odds are not in my favor. 50 to 1 payoff? No, thank you. For 50, if I don't see anything that I can leverage for a return, it's not worth the trade. 505s have a shot at 50 cents. Are they too expensive? Again, probably to look to trade around the wiggle to take off that trade. And then if news comes out, I may have missed it. Maybe I can get back in 4 hours with no news and say, now I've got the lottery ticket for later in the day. But I don't want to decay out my lottery ticket from 50 down to 20 over the next 4 hours only to have it pay off. I'd rather save the $30 and then buy 2 of them for 20 cents and say, okay, now I've net, if nothing happens, I've lost $10. If something does happen, I missed out on the opportunity to make the money. But that's trading, right? And people are selling the 497 straddle now a little bit. It's trading on the bid, not in huge size. We're still trying to figure out our market for today, just like we were yesterday, right? Yes. I go back to finding a technical move today is all going to be about looking at these like 10-minute charts. We had a bounce here. If we get back above some of these short-term highs, session highs, it might set up for 503, 504. And I can use the 505 calls for that move still. I just know that if we don't get through this high, I got to be out, when we get there. So if we get there and then start to pull back, I want to get out. Take a little bit of money and run. If we get there and keep pushing, then I can just ride it with a trailing stop. 15-minute chart, it's a little bit slower. If I really want to be in a chart, I can start to really fine-tune this down and just actively trade it over and over all day. But again, I have to be a pattern day trader to do that. So keep that in mind. Depending upon your account size, do you want to be a pattern day trader? And I will say on the risk side of things, if you've got an account that's like $26,000, yeah, your account's locked. No more trades until you're back above 25. So you either have to put more capital in, recover the loss, or stop trading for, I think it's a year. So that's not worth the risk if I'm at 26. If I'm at 100,000, I'm not necessarily worried about pulling my account down below 25,000 for pattern day trading. But if I have an account of 25 or in that range, I might be okay to pattern day trade today, but maybe not tomorrow. So it creates a lot of psychological elements and frustration and emotional side of trading. And I don't want to initiate trades that will create emotional responses down the line where I'm trying to make sure I stay above 25 in order to maintain my account balance for pattern day trading. Then I'm making decisions that are not based upon normal trading philosophies. I'm making them based upon restrictions that I've now initiated for my own account. So, like I said, if you have a smaller account, I wouldn't necessarily get into making 3-day trades in a week. I would just wait till the account starts to grow and then start looking at potential day trading opportunities. And for now, that means maybe looking at March 6th calls, holding them overnight and hedging. I could say that buying a 505 call today for tomorrow on a breakout makes sense. And then if we get towards the highs, I sell a 510 or a 515 call against it to turn it into a call spread. That's reduced my capital expense. It's reduced my exposure. On a $10 rally, I expect that I get at least what I paid for the 505s on the 510s, probably a little bit more. So I've got cash in my pocket and I've still got further upside. And that's how I take off half the position. I've sold out half my position by putting it into a spread. If I want to sell almost the entire position, I sell the 506 call, turn it into a $1 call spread. I'll have a little bit of upside left, but then I've at least gotten almost all my cash off the table. Ways to just kind of manage the desire to day trade or to leg into spreads instead of actually maintaining it. But I can't do that with options expiring today, because if I have to close all my trades today, then now I'm a pattern day trader. All right. So Fred, I think that when you're talking about IBIT versus Mara, I think based upon where we're at, I like, and then the implied volatility in the technical levels, I like the put credit spread in IBIT, and I like the more legacy Mara has the potential for 19.5, a 30 to 40% rally, where IBIT would be looking for like an 8% rally. The implied volatility here is 56. The implied volatility in Mara is 100. So if I think there's 30 to 40% move in Mara off of an 8% move in IBIT, I'm looking at 4 to 5 times the move when the implied volatility is only twice as much. So if I see them moving in line in their implied volatilities and to the technical levels, a $4 move in IBIT should be about a 15% move in Mara, $2, 16 and a half. If I think it's closer to 19 and a half, which is sort of my thought process, then I want the long call in Mara. If I think it's closer to 16 and a half, then these are a neutral trade. They're effectively the same. Go for whichever one has more liquidity. All right. So more upside to Mara, more potential for just anti-bearish in IBIT. So yeah, I like the put credit spread in IBIT. I like the call side of Mara. MSTR, you know, it's such a wild trade, but 233, similar kind of support level here. You just see how those are being priced in. A dime for a $2.50 wide put spread is not enough to get me excited. So IBIT better than MSTR in that perspective as well. MSTR, if it goes crazy with Mara rally or with IBIT rally, 330 is in the cards. It's about 18%. Is that right? $43. $48. 20 divided by 28. 20 divided by 28 is about 17%. So it's a little bit more leverage than IBIT to the upside for the implied volatility levels, but it's not huge. Like I said, I think Mara just has that much more, and maybe I'm wrong. Maybe MSTR goes to 380, and then in that case, it's clearly a good leveraged upside trade. But maybe I'm wrong, and a retest of the lows, and IBIT also puts MSTR down to like 200. Everybody sells it, and then I'm even worse off. So I think IBIT's a little more secure for the put credit spread, as I outlined for now. Maybe HUT or BTDR should be also looked at here. Again, let me double check those. HUT's already testing support. I mean, similar to Mara, this could go to 20. So coming from 14 to 20, same implied volatility. So again, April 17th, $16 calls, about the same price. A little bit wider on those. You know, I'd look for execution quality. It's a little bit of a challenge. Somebody's out there buying some $20 calls for April. So there is a little bit of bullishness out here. Buying them. Are those, yeah, you know, 500 of these for 62 cents. We're seeing some interest on the buy side in HUT for the 20 calls. Maybe that could be a signal for a stock that doesn't trade quite as much as, you know, Mara or what do they normally trade? About 1,600 contracts a day. Oh no, that's 1,600 a day. Average is 15,000. Marathon normally trades about 290,000. So 500 contracts in HUT is actually a big trade for HUT. Comparable trade in Marathon would be, you know, like a 10,000 contract trade in terms of a percentage of the average daily size. BTDR, even last 10,000 normally. Are we seeing anything in the stock? Yeah, similar to Mara, right? From 12 to 16. A little higher implied volatility, or sorry, from 11 to 16. So about a 50% potential return, but a little bit higher implied volatility. So again, very similar kind of trade idea, but even less volume here and no dollar strikes. But the 12 and a halves would fit fairly similarly to like the MARA 16s or the HUT 16s. Okay. So, but these don't have to move with Bitcoin either, right? We had from November 27th to January 3rd, a nice upside movement in BTDR. And during that time period, we were just kind of grinding out a little bit higher in Bitcoin. That was most of that move happened with Bitcoin near the highs. So maybe that's why HUT is lagging. Is maybe they're more leveraged to prices above $100,000 a coin, and they're a better play in the $105,000 range for Bitcoin, which we're not there yet. So if my play is to get back to 100,000, then I don't want to necessarily go there yet. And after we get there, maybe I'm taking profits in Marathon and going over to HUT at that point, or BTDR at that point, not HUT. BTDR may be best leveraged on higher crypto prices. You know, there's like oil companies out there that make a ton of money, but their break even is $100 a barrel. And they make a ton of money above $100 a barrel, but they're priced lower because if we're below $100 a barrel, they can go bankrupt. versus like, the Saudis, they're not going bankrupt with oil at $30 a barrel. And they're making a ton of money at $100 a barrel, but that gets priced into their fundamentals. Let's see what else we got here. Yeah, so you want to, okay, so if you want to own IBIT and do it, and you're thinking covered calls because you don't want to necessarily just collect the premium for the downside put spread for 15 cents. I get that. So that's where I look for a technical level, saying, where am I comfortable trimming my position? So if you want to do a covered call type position, I do want to collect that premium. I want it to decay, but if we get a quick move, I'm okay with getting pulled out. Something like the 56 calls would line up here, 56.5 range, 57 range. And then it's just about determining what percentage of the current value I need to collect to justify the call sale. So if I own the stock for 50 and I sell the 56.5 calls for 70, I'm collecting 70 cents. I'm collecting about 1.5%. And that's for a 2.5 week holding period. If we go to 56.5, I'm making 12.5% on the stock and an extra 1.5% on the option. If that's a price that I don't want to be selling out my IBIT, then I may not be able to do that. I may just have to buy the stock and skip the covered call, or buy back my covered call and replace it with another one. So one of the ways that I've traditionally looked at a covered call strategy is if I sell a call that's out, within say 2 to 3 weeks of expiration, if we start getting close to my strike, I roll out and up. If I'm comfortable continuing to hold and I don't want to get called away, I buy back my March 56.5s and I can add a week. And right now, the next week would be the $58 calls. If we start to appreciate in price, it may be closer to the 59 calls. It may be still the 58 calls, but that's my cost neutral way of raising my call away price without having to put more capital in during the rally. So it's just about managing it once you've got the covered call position on and knowing where I need to roll the position to a higher strike with more time. If we get to 57 quickly, I can go out to April more than likely and sell something like in the 60s for a new all-time high. 61.25, 61.5 was the all-time high, and start playing off of that level instead. But I gotta always be wary of that opportunity to roll it up, which then means my premium collected won't be much, if anything, for that next month, but I've got all my appreciation in the stock. And if we don't get there, I got my covered call premium collected. So if we get there, I got my appreciation from the stock. If we don't get there, I get my appreciation, or I get my credit collection from the covered call. Yeah, is there anything else you guys are looking at right now? I mean, I don't want to belabor too much on this stuff. We've got Qs drifting down a little bit here now. So it was that intraday stuff where, for those monitoring the intraday, spike, fade, below today's low is bearish, above today's high is bullish. Right now, I could see us doing both. I could see us doing neither. Low probability of neither. I don't think we're going to stay quite in this range of 492.5 to 498. We may settle here, but I got to imagine that we're still in for some a little bit of volatility today with potential news sitting out there. But I think it's just a new daily low is bearish. Below yesterday's low is very bearish, but I start looking for ways to take the profits on the bear side. Above today's high is bullish. Above yesterday's high is very bullish, but I'm looking to trim positions as we get close to yesterday's high, trim as we get close to yesterday's low on the bear side, and then potentially a trailing stop above or below, and start looking for individual trades above and just staying with ETF trading below. All right. Silver's still rallying. Oh boy. If not interested in taking profits, I think just have trailing stops and remember that tariff news or non-farm payrolls could move silver either direction. So the risk is on the biggest risk I think in silver is going to be coming from